Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, maybe there's an implicit agreement afoot, and that changes the expectations on QE2. It also means that the euro loses a prop to a degree on its currency from China FX reserve allocation. If China agrees to start letting its currency appreciate and reallocating those reserves domestically, it's not going to have that money there to buy European bonds and push up the euro. So the euro tends to lose a prop there, and that's why our target is, if this policy is afoot, at least from a corrective standpoint and a very good correction to play, the euro is on the top of our list, and I'll get to that in just a second. Commodity currencies could take a premium hit. There's an agreement in play, just less liquidity being thrown out there by the U.S. And China agreeing here, which means this implicit agreement would also lead to a slowdown in China's GDP. Again, not a stop and not a major dislocation, as Japan experienced, at least that's what they hope. It means that the commodity currencies would probably take a hit, and they'd wash out some of that premium in there to a large degree against the U.S. dollar. But ultimately, we think, again, if this is in play, and this is a stretch, I have to admit this is a story that's was a bit of a stretch, and is becoming less of a stretch as we watch the events pile up. But if this story does start to play out, we think the commodities currencies turn over against the U.S. dollar, but from a corrective standpoint, whereas the euro could be pushed back into its longer-term bear trend. British pound really is at the mercy of growth expectations, which are in trouble in a very big way now. The cut by the UK government, in one sense, you have to really say, give them major kudos for really just grabbing the bulls by the horn and making such a massive cut, government expenditures. But in the near term, because of the other austerity measures, and just the global demand not being there, the growth prospects may be so bad for the British pound, although they had a decent GDP number reported today. But going forward, if they do have, the growth numbers really do look nasty because of the cuts and the austerity, we would actually see more quantitative easing from the Bank of England, which ultimately would hit the British pound. We're not sure we're there yet, but I think that the story is there for all to see. So we're just watching the growth expectations going forward and how they play out against reality. Pound jumped today on better than expected growth expectation. Trade war scenario, the game just changes in a big way, and we get a massive flood probably back into the U.S. As a hiding place. And the dollar gets a major risk bid. Technically, where are we? This is the all-time low in the U.S. dollar. This is the U.S. dollar index, all-time low. This was that big retracement where it bottomed in December 2009 and rallied up. Now we came pulled back again right on this trend line, interestingly. The sentiment numbers here look very much like they look here against the U.S. dollar in terms of bull bears, almost exactly. Just ugly, ugly sentiment, thinking the U.S. dollar is going to fall off the cliff again. Also, when we look at this, when we do our wave analysis, we're looking at this as a wave one up. Really, is what we're looking as this move of a broader wave three, and we're looking at this as a corrective wave two. We're looking at this as an A, and a B, and a C. And if you look at it from an Elliott standpoint, A, B, C correction, it meets it very well. On a zigzag correction for Elliott, and it really was a very decent point in which it should have turned from a time standpoint and from a distance standpoint, and it turned pretty much on cue on that trend line. So that's another reason from a technical standpoint we think this background story makes some sense. The idea that any change in QE2 expectations will probably hit the risk asset markets, meaning so much of this premium has been bid into the risky assets and stock prices. The question obviously being asked is how much is in the price. We think a lot of this QE2 is in the price. So if the expectations change and they pull back on it, we would expect the Dow Jones Industrial Average, S&P, to turn over, and all risky asset markets measured by stocks to start to turn over. This is a chart showing the U.S. dollar index in black here, as I just showed you before, and the red line is the Dow Jones Industrial Average, and you can see how highly correlated these are, which is a direct reflection of using the dollar to pump up risky asset classes. And interestingly, we had hoped that after the credit crunch and interest rates started to normalize, we would start to see these tight correlations go away in all these markets around the world. But the fact is, interest rates have not normalized. Everybody's pumping liquidity out there. So these correlations across these asset classes are as tight as they've ever been. Steve and I have been discussing some of this stuff offline. Steve's been sending some really nice charts showing how tight these correlations are on the numbers standpoint. But you can see how tight this correlation is in the U.S. dollar and the stock market. So if this is in play, lower expectations, too much already priced in, we would expect some type of correction in the stock market, and that, of course, to lead to a correction higher in the U.S. dollar. Over here, it's the same chart. On the right is the same chart on the left. We just added the green is the Australian dollar, so you can see how tightly the Australian dollar as a risk appetite currency moves with risk assets, how tightly it moves with the S&P 500, Dow Jones Industrials in this case, and of course the U.S. dollar here. That's why we said if we see some type of turnover on this move, we would expect it to hit the commodity currencies. The Australian dollar the hardest because it's gone up the most of the major commodity currencies. We expect a hit there, at least a premium fallback, but if some growth materializes out there, we would expect them to stabilize and trade fine going forward. One of the things we've also been watching, again from a correlation standpoint, is the 10-year notes. And the 10-year note, as you know, this is the 10-year note futures, or these are bond prices, which are inverse of yields. So as this goes up in value, yields go down. So all this QE2 expectations of more money in the market leads to buy-in of bonds. Well, we finally saw a break today in a big way of this daily uptrend going back all the way back to April in the 10-year note. Then I direct your attention to this next chart, which shows 10-year notes compared to the S&P 500 compared to the euro. And this is a shorter-term chart on a 4-hour basis. The 10-year notes are the black line. The green line is the euro, and the red line is the S&P 500. You see how tightly correlated these are even on a short-term basis. We started to get a little divergence on this first box here that we pointed out to some of our clients when we saw that right away. We saw this divergence here. These guys still holding up, and sure enough, they both came back to a degree with the 10-year note leading. 10-year notes rally up again, these guys taken off again, then another divergence started, and a bigger divergence today, as you can see from this breakdown on the dailies. A bigger divergence has developed here, and sure enough, the euro started to turn over following the 10-year notes, but the market still held up today pretty well. So this is another thing on the way we use the intermarket analysis to help, just to help build our story technically, which is intermarket's kind of a mix of technical and fundamentals. And that chart in there again. Euro, the high may be in the bag in the euro here. We've looked at this move as a corrective move. We haven't believed that there's been a whole lot of changes fundamentally to the core problem, structural problems in Europe, even though we've seen some of the risk spreads come in a bit, and some concerns of sovereign default go away. But we're looking at this as an A, B, C correction in the euro, and again it meets these pretty well. Obviously, if we break above a new high back here, 141, the euro could quickly go to 145 level. But we're looking at this as and then this latest move as the first break, a test, and now a break again, and we have a target of 133 for a move down in the euro.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcast.